Good afternoon, everybody, and welcome to this edition of our Think Learning series, How to Create an Investing Plan. My name is Carl Capolingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we investigate all of the ins and outs to laying the framework for your investing. The Think Markets difference is important. We'll talk about this very quickly before we get started. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. Four fantastic reasons why you should make sure your next ASX share trade is with Think Markets. The agenda for today is to discuss the key elements on how you can create your investing plan, but we'll do that after we discuss why you'd want to create a plan in the first place, and then I'll give you a sample investing plan at the end as well. So some practical takeaways from today's session. Of course, today's session is being recorded, and many of you who are listening to this are listening to the recorded, but for those in the presentation live today, if there's anything you felt that you missed or you'd like to catch up on, you can always head to our market news section of the website and check that out. But let's get going. Okay, there's the famous saying. You can't have, I think, a webinar on creating an investing plan without this saying. If you fail to plan, you are planning to fail, and that's from Benjamin Franklin. So that saying has been around for at least a couple of hundred years. And what does he mean by that? Well, if you don't have a plan, you're unlikely to succeed. What is an investing plan? Well, it's a set of rules that dictates how we behave in the markets very comprehensively. Everything from what we do in our setup and our investigation of the market, how we behave once we're in an investment, so our entry rules, it might be our position sizing, our exit rules, then how we assess our performance as well. It says down there, it defines our goals, our style, commitment levels, entries and exits, position sizing, and capital management. So, as well as obviously the ins and outs, how you get in and out of the stock, there's a lot more to it than that. How do we behave in the markets? Now, why might you want to define all of these things? Well, often when markets get crazy, we've had a crazy year. If you look at the last 12 months, reports today that, at least in the United States, and it was a day earlier in Australia, but having our 1 year anniversary since the 2020 pandemic lows, and markets are up, if you look at the US, over 70%. So we've had a wild ride, and when things get wild, often we might panic, we become emotional, and we make poor decisions when we're emotional. So an investing plan should always be able to answer this question. Okay, so what do I do now? If you're ever confused, if you're ever not sure what to do, that investing plan is there to tell you what you should do. It also allows us to compare our actual actions from our intended actions. So sometimes in the heat of the moment, we do make those poor decisions. If we don't have what we're supposed to do written down, how can we go back and compare our actions to what we're supposed to do? How can we say, look, I did a fantastic job there. I really executed that plan well. I didn't get the result I wanted, but I executed the plan well. Or, you know what, I was completely at odds with my plan. And look, I achieved a terrible result in response to that. And this helps our consistency. We'll talk more about consistency on the next few slides, but consistency is really just doing the same thing over and over and over again. And it helps with our discipline. And I think we can all relate to stories where we haven't shown fantastic discipline in the markets and it's cost us dearly. And the most important thing perhaps down the bottom is it helps us control our emotions. So there are a bunch of great reasons why we should create an investing plan. A quick note on consistency. For me, this is one of the most important factors of good investing. It is one of the key things you have to get right in your journey to becoming a good investor. There's an old computer programming adage, and that is garbage in equals garbage out. So if you are random with your inputs to your investing, so you have no real plan, you do things differently based upon whatever the market conditions are, and then market conditions change, you're doing something completely different again, you're going to get random outputs. Okay, it doesn't mean you're necessarily going to get terrible outputs, because we've probably all been in that situation where the market's fantastic. We've had a pretty good bull market over the last 12 months, and lots of retail investors out there thinking it's easy because, hey, stocks go up all the time, don't they? And they might be doing completely random things and getting a fantastic random results. But that's not sustainable. When the market does change, they're going to have a very tough time because they can't really pinpoint what they're doing to get their success. And I'll just give you an example here of how we can be less random in the market. Now, I've used a technical analysis example, but we could equally use a fundamental analysis example in this case, but this one's just easier to draw a picture and illustrate very quickly in a webinar like this. So let's say instead of simply responding to what market conditions are, responding to what the Federal Reserve Chairman Jerome Powell said last night, or the latest economic data release, or company profits, and jumping into the market on the basis of chat rooms or rumours, instead we set a bunch of rules for our entry and exits. For example, when the price of the security, and the price are these lines here. If you haven't seen a chart before, we've got price on the y-axis here. So this is price, and we've got time clearly down here, and just how the performance of the company's trading over a period of time, represented by these bars, from which each bar represents one trading day. So when the price of the security, it doesn't matter what security it is, it's irrelevant in this example, when the price crosses below our 200 period moving average, we are going to sell. When the price crosses above the 200 period moving average, we're going to buy. It really is that simple. If it's not crossing above or below the moving average, we do nothing. We're either out or in the market. So for example, you would have sold, I would say, on this day, let's assume you had bought somewhere around here, and you sold out here, and then you bought back in here, and then you sold out here, and then you bought back in here, and as we are today, you would still be owning the stock. Okay? Is there any confusion as to what you need to do? Well, absolutely not. It's very clear cut when one line is crossing another line. So there's no scope for being random. Something happens and you do something as a result. And probably you would have maybe made some profit on your first trade, let's say, for example, then you would have made a little loss on this trade here, and you'd be making a reasonable profit on this trade. Okay. Now, that's irrelevant, profits and losses, and it's just an example. But what we're trying to show here is the importance of this element here, consistency. You can do this over and over and over again. You can continue to repeat these actions, okay? And the results you're going to get are going to be far more consistent. So, if we enter based upon a set of rules, and we're going to generate from those actions a set of results. Okay, so if we are consistent with our input, we get a consistent set of results. Now, just the way I've drawn it here, if this is our performance in terms of how much profit we're making over time, certainly that looks like a good performance, but we could equally experience a performance like this from doing something equally as consistent, from following the rules. But it gives us the ability to go back to Rule 5 and say, you know what, after experiencing this consistent set of rules for a period of time, I'm really starting to feel that Rule 5 is the problem here. I'm going to take Rule 5 out, or I'm going to change Rule 5. Okay? And then after a period of time, we'll see how our equity curve responds. Potentially, we amend Rule 5 and our equity curve improves. And that tells us that we made a sensible decision. Or we amend Rule 5 and our performance gets worse, and we know we need to go back to the original Rule 5 to at least get back to here. But it's the consistency in our approach that gives us the ability to improve our results. If we are random over here, as we saw, how can we possibly know which one of these factors is causing the problem, which one of these factors can be tweaked to get improvement? We can't. So that is the importance of consistency, and why we should all attempt to adopt a consistent approach. Okay, but we must accept our limitations. Certainly, some of us have more time to be consistent, to apply our trading and investing plans. Some of us have more or less commitment as well. Some of us have more expertise. Okay, and here's a good ready reckoner for what you should expect. Pretty sensible. The more time, the more commitment, and the more expertise you can apply, well, the more markets you'll be able to cover, the more stocks within those markets you'll be able to cover, the more systems you'll be able to apply, so different trading strategies you'll be able to apply, and therefore, the combination of all of those things, you're just simply casting the net wider, aren't you, to increase your probability of having a greater profit. So the more time, the more commitment, and the more expertise you have, ultimately the greater the profits you can expect, because you can cover more of these things. Okay, so where are you? Where are you on this spectrum? Are you somewhere down here with very little time, very little commitment, and very little expertise, or are you further along the line? Okay, it'll determine what you can do over here. Okay, so what sort of analysis are we going to use? And this is directly related to our time, commitment, and expertise, as we're going to see in the next slide. And the two broad fields of analysis, and many of you probably will be familiar with this, so I won't spend a lot of time on it, but fundamental analysis and technical analysis are the two broad fields, and fundamental analysis is the study of the company and what it does, its financial performance, its management, the industry within which it operates, the economy, the current macroeconomic situation, big driver of share prices over the last 12 months, political and geopolitical factors. And we know, for example, central banks, federal government stimulus measures that have been put in place, they're all having impacts. Very recently, some tensions between the US and Russia had an impact on the oil price. All of these things must be taken into account when? All the time, in real time. These things are happening in real time. Think about the onus on you to take into account all of these factors in real time. Think about the onus on you to have the expertise to be able to understand these things, and then translate that into investing actions. Technical analysis, well, that's a little bit different. We're not studying necessarily what the company does, we're just studying how the price of that company moves over time. And we can use tried and true tools, methodologies in terms of price action indicators to help us forecast future price movement, trends and reversal points. Okay, in my experience, I would say that it's harder to source accurate and timely data for the analysis, and then to conduct that analysis. Okay, this is a separate point, isn't it? It's not just doing the analysis, it's getting the data. Trying to get the data on the financial performance for a company, you would have to go to the company's website, the investor portal, and download a bunch of documents, and then pour through those documents. Some of them are hundreds of pages long. Compare that potentially to getting a stock price or stock data from your broker, and then plotting a chart and looking at that chart. So it's far easier to even just get the data, let alone conduct the analysis for technical analysis. And I'm not necessarily trying to steer towards technical analysis, because it really depends on this. Okay, if you have greater time, if you have more commitment, and you have greater expertise, then certainly you can steer towards a more fundamental analysis approach. However, I would suggest if you're very time poor, commitment poor, and expertise poor, you probably want to gravitate more towards a technical approach. Okay, and that's a decision you need to make. I'm just trying to help you understand how and why you might make that decision. Okay, we keep mentioning these three factors, don't we? Time, commitment, expertise, and really take a hard look at yourself and question your ability to apply those three things. However, the good news is you don't have to do it all yourself. There are a number of listed investment companies out there, and what they do is you invest in the shares of these investment companies, and they go and do all of that research. They do all that fundamental research. Well, how and why can they do that fundamental research? Because they have the time. They're getting paid to do it. They have the commitment. That's what they do for a living. And they have expertise. If you look at an investment team, there might be decades and decades of experience within that team. Okay, so you can get somebody else potentially to do that work for you and simply invest in the company that does that. There are also fund managers you can park your money with, or potentially ETFs, which have give you exposure to a bunch of different securities as well, and they're exchange traded as well. So some fantastic ways you can shift that onus of time, commitment and expertise to someone else and still take advantage of investing in the share market. Good news is also Think Markets, we do quite a bit for you as well. So we do have stock-based research reports, okay, where we'll give you a buy, hold or sell and a price target on a particular stock. We also have our Think Technical regular updates, where we look at technical factors and technical analysis factors for companies. We cover all the stocks on the Australian market. We've got our 3 series webinars, so we've done 3 sectors to watch, 3 small cap stocks to watch, 3 stocks with dividends and growth, and we continue to do those through the course of the year, and you can tune into those and get some great investing ideas. And of course, every fortnight we've got Ask the Experts, and that's a webinar where you bring your portfolio to the table and ask us what we think of those stocks. So when you look at it here, there is a huge amount of information, a huge number of resources that we provide for you as our clients. Okay, moving into, I guess, the steps of actually creating your investment plan. So up to this point, what we've done, we've assessed our situation. We've understood what style, what approach we should take, whether it's fundamental or technical, and we're starting to get an idea of what our time commitments can be and our expertise levels. So once we've done those things, let's start to set some goals for ourselves. The goals should match the time commitment and expertise, there they go again, that we're going to apply. So, if we've got, we saw that chart before, of profitability, and they're related to these things. So if you don't have much time, you don't have a lot of commitment, and you don't have a lot of expertise, how can you expect to make 100% per annum? That's ridiculous. So you need to have a lower performance target. Okay. Now, if you want to go get more of these things, that's fantastic. You can have a higher performance target. It's harder to get more time commitment and expertise sometimes. Your goals will also determine your required risk. So if you have a goal target, so let's say we have a profit target of 100% per annum, you have to consider the risk you're going to take to get there. Okay, so if your goal, and you sit down and you're starting to write out your investing plan, is I want 100% per annum profit, and I'm only prepared to risk 2% of my portfolio. I think that is probably ridiculous. Okay, that's absolutely silly. You might need to put a 0 in there to have any chance to get to that one. These two values need to speak to each other. And obviously, the higher the profit you want to achieve, the greater the risk you must take to achieve that. Hey, if you're a person who doesn't like a lot of risk, then you need to rein in your profit expectations. Okay. Sensible examples. And I guess I'm trying to give you an example of that. So your maximum drawdown here is your risk and what you might be trying to achieve. And let's say you might go, a sensible way to do it is to go ASX 200 plus. So let's say the ASX 200 returns 10% over the last 12 months. Well, in theory, if you just put your money in an index fund, you would have got that. Okay, so if you're going to manage your money yourself, you should at least beat the index. Right. So in that case, you might say, I wanted the ASX return plus, say, 5%, which is pretty reasonable, to give you a 15% target return for the 12 months. But this will change, won't it? If this is the ASX return, it will change. And you might have years where the ASX return is minus 10%, okay, in which your goal would be simply to only lose 5% of your capital. Okay? But if the ASX was down 10%, you only lost 5%, you've beaten the market. Okay, understand your risk tolerance kind of follows on from the last topic. Obviously, the higher the return we want, the higher the required risk, if that makes sense. And there's a nice saying over here. This is from Jesse Livermore, who was a legendary 20th century stock trader. You can check out the book written about him, or loosely written about him, called Reminiscences of a Stock Operator. And that's written by the author Edwin Lefebvre. Just Google that, you'll find it. And he's the saying, if you can't sleep at night because of your stock market position, then you've gone too far. If this is the case, then sell your position down to the sleeping level. So if you can't sleep at night, you've got too much risk on the table. Sell your positions down a little bit until the night you can sleep, and you know that's a comfortable level of risk for you. Lower risk tolerance, better suited to fewer trades, longer time frames, fewer monitor points, and it goes the other way. So if you've got a higher risk tolerance, you can take more trades, you can have a shorter time frame, and greater monitor points. And this is probably the key one here, monitor points, because the more you look at the market, the more likely it is you are going to make mistakes because of emotional responses to the markets. The more you look at the markets, the more emotional you're going to get, and the worse your investing becomes. So, look at the market fewer times, have a longer term time frame, make fewer trades if you've got a lower risk tolerance. In terms of risk management, there are three very important factors we need to consider. So how much we're going to risk on each individual trade, how much we're going to risk at any one time on our portfolio, and how much we can withstand in terms of a period of poor performance. And that's the definition of that is our drawdown. Okay, or drawdown. The definition of drawdown is what I suggested, how the degree of underperformance over a period of time. And clear rules here will promote consistency. Okay, let's have a look at some examples here. So per investment risk specifies the maximum risk we can have on each trade. And the common terminology we use for this is our percentage R, okay? And that is typically described as a percentage of our total investment capital, okay? And I've just used an example here of 2%. It's fairly common. 2% is a fairly common amount to risk of your total investment capital. Some investors prefer to be a bit more conservative. They might use 1%, or even as low as 0.5%. It really is up to you. I would suggest, however, so this is a lower risk tolerance. Higher risk tolerance you wouldn't go any higher than say 5% on any trades. Once you start to get over 5%, you really are taking a greater amount of risk of a significant drawdown in your portfolio. Okay, so I would say not higher than 5%. Because if you have a portfolio and if you've got, say, 20 trades in your portfolio and each trade has 5% risk, then that's 100% of your portfolio at risk. So if there was a catastrophic event, you could lose all of your capital. So it's important to get this percentage R right and keep it small enough that if your portfolio is wiped out at a particular time, you're not going to risk too much of all of your capital. Okay. So portfolio risk is specifying the total risk allowable across all of those little percentage R's. Okay, so we're adding up, we're looking at the sum of all of our percentage R's, and that's our portfolio risk. For example, the risk maximum of 20% at all of our active stop losses in the market. And then drawdown risk is, as I said before, it is how much you lose over a sustained period of losses. And we're going to specify the actions to be taken if our equity falls below a certain level. And let's say, not a chart of a stock here, but chart of our performance. Let's say we started with $100,000 and we started off pretty well, but then the market had a big turn and we came down to here, and now we're at $90,000 in terms of the equity we have left. Okay, well, how do we respond? Do we just hold on and hope for the best until we're at 80,000 equity or 50,000 equity or $30,000 equity, or do we take some actions? Okay, now if you've got stop losses in the market, that should give you some protection. But also we could have a period where we start to restrict our trading. For example, new trades only are allowed to have half of our usual risk percentage. And if that risk percentage was 2%, you'd only be taking 1% on your next trade. If it was 1%, you'd only take 0.5% on your next trade. So if losses continue, at least it'll slow down the rate of losses. Okay, and that's a start. You might have a point, and let's say it's here at 85,000, where you pause trading. You just don't take any new trades. It could be a point where you exit all your existing trades because clearly the market is not doing what you thought it was doing. So perhaps the best place for you to be is on the sidelines. So we might have a point where we pause trading. Now you need to have a point, if you've paused, where you recommence trading, okay, where you start to phase back in. And that might be after the market, the broader market that you're trading within, returns above a particular moving average. And I've just picked 50 here as an example, but it could be the one that you like to follow. And you're going to then recommence at 0.5% until your trading improves, and and you're only getting back into the market because the market's improved, and you get back to a certain level where it triggers you moving back to your normal risk percentage. Now, this is not entry-level stuff. This is very, very advanced risk management, okay? But it gives you an insight into how complex sometimes your investing plan needs to be. If it was simple, everybody would be doing it in many ways. Okay, let's talk about adopting a suitable methodology. So we've determined our ability to service an investment plan. We've determined our goals and our risks, and we've determined our risk management philosophy. Now, how do we actually get into and get out of stocks, and when are we going to check those stocks? So the universe is, what are you going to trade? Okay, and I would typically say make this as big as practically possible. Okay, the more stocks you can cover, potentially the more profit you can make. When are you going to conduct your analysis? And you need to be consistent with this. So if you're going to do it each day, for example, you are there each day that the market is open to conduct your analysis. If that's too hard for you, then do it each week. Okay, but you are committed to conducting your analysis in line with this periodicity. Okay. Determine some entry and exit rules, and this is not the webinar to do that. We have other webinars where we talk about fundamental analysis, where we talk about technical analysis, and some rules you can begin to investigate and adopt into your trading plan. This is about creating the plan itself. So I haven't given you any specific entry or exit rules here, although we did a case study earlier on, didn't we, with that technical analysis system. But whatever you use, it should be based upon easy to source, timely and accurate information. And we see that it's much easier to source timely and accurate information for technical analysis than it is fundamental analysis, and those rules need to be clearly defined. We talked about having those clearly defined rules to give us clear and consistent results, and then you need to work out, once you determine how you're getting in and out, you need to determine how much you're going to get in and out when you do it. And I would suggest we talk about risk management here, or consider risk management here, which we did just talk about, and then also diversification, very important. I'll leave that for you to investigate on yourself because we're running short of time, but pretty straightforward. Don't put all your eggs in the one basket. Okay, now we're trading. We've obviously done everything up to this point, and we are now trading. We've got results that we can now monitor. It's not just a matter of monitoring your results, it's also monitoring yourself. So if we keep good records of how we behaved, of our rules and our performance, it should be easier to do this. So that would be the first step, keep good records. And then, really, it's the ongoing periodical position, portfolio and performance analysis, and we're doing this in line with our periodicity. So if you set it as daily, you're doing this every day. If you're doing this weekly, you're doing this each week. If we can follow the plan, we've talked about this, we should get consistent results. It's from those consistent results we develop this thing here called the feedback loop. Okay, it's the feedback loop that we can then make refinements to our system and find improvement. Okay, we can make those consistent changes. Okay, we change one rule in a very consistent way, and we see how our performance changes. And if it got better, we can continue to do that thing or tweak it even further. If it got worse, we know not to make that change. Okay? Without the consistency, you can't get the feedback loop. Without the feedback loop, you won't know how to refine your strategy. Without knowing how to refine your strategy, there's no potential for improvement. So this is a very important part of the process. Assessing plan strengths and weaknesses, what went right, what went wrong, formulating changes, testing those changes, documenting those changes. And once we've done that, we simply go back to step one, okay, and do it all again. It's a dynamic process. It never changes. We keep doing it. Okay, so as promised earlier on, we'd have a sample investing plan. This is something you can literally take a snapshot and start writing stuff in on your computer or print it out, or copy and paste these items into a Word document and expand upon them. I'm really just giving you the skeleton of what you need to do here. But there are various stages of, not so much the trade, I guess, but of our development, of our performance, of our activities. So we've got our planning, implementation and trading style assessment stage, where we're going to consider our goals, our style, our periodicity, and the universe we're going to trade. And you're just going through and saying, my return goal, well, I'd like to make 20% per annum, or I'd like to go ASX plus 5%, for example. And I would not like to experience during a particular year a maximum drawdown of more than 20%. And I've shown you how to manage this process here, haven't I? I'm going to be a bit more of a short-term trader and take a daily approach. Yep. So I've determined how often I'm going to check the market, and my scanning universe is all ASX stocks. Now you might be looking at NASDAQ stocks. I don't know. Okay, you might be looking at foreign exchange or commodities. That's up to you. But the overall themes of the plan remain the same. Methodology, our entry and our exit rules. Okay, how do we get into and out of the market? So you would list here your fundamental, technical. You could use a mix of the two, or other rules for validating an investment. What gets us in, what gets us out? Do I have a valid setup? How strong is my setup? Sometimes you'll have lots of valid setups. Well, then how do you differentiate between what are the best setups? Exit rules, these are equally important as your entry rules. In fact, I'd almost say they're more important, because this is where the money is made or lost. Will I sell? So once we have triggered an exit rule, do I just sell straight away? Do I sell after a day, after a week? Or do I have a stop loss in place that takes my discretion out of it? A lot of people like this methodology here, because often if you say, look, I'm going to, after it's been triggered, I'll sell the next day, or I'll sell at the end of the week, you might not have the discipline to apply that. Stop loss lets the computer do that for you. So that's pretty important. Consider whether you want to use one of those. Okay, risk management, very, very important. We've talked about the 3 ways we can do it: per trade risk, portfolio risk, drawdown risk. Okay, and performance monitoring. Are the goals of the investing plan being met? Are we sticking to the plan? We're monitoring the performance of the plan. We're monitoring our performance as well. Can we refine our approach? Formulating improvements, testing, validating those improvements, and documenting everything. Okay, in conclusion, when is the best time to implement a trading plan? And there's an old saying out there: when is the best time to plant a tree? Well, the best time to plant a tree was 20 years ago. When's the best time to construct your investing plan? Probably 20 years ago. And if you haven't been doing the things I've been talking about today with the consistency, with applying the requisite time, commitment, and expertise to those things, you're probably wishing that you started doing all of those things 20 years ago. But hey, let's go back a step. Best time to implement a trading plan, if you couldn't do it 20 years ago, is right now. So that 20 years from now, 5 years from now, whatever the time frame is, you're going to get those rewards. Okay, and the rewards are substantial and they're worth investing the time into. So in summary, a sound investing plan covers the methodology, how you're going to do it, risk management, how much you're going to risk when you're doing it, and you're monitoring how you're going, how the system's going, how to improve what you're doing after you've done it. This is actually probably the most practical page in the presentation because it tells you some resources. It gives you some resources that you can use to go and solve some of these problems that we've probably created for you in this webinar. So in terms, some good resources for you in terms of the methodology. Of course, Think Learning. We've got a bunch of webinars out there that we've done in the past. If you're looking to do take on a fundamental analysis approach, go check out that How to Value a Stock webinar in the market news section of the website. We've also got an Introduction to Technical Analysis webinar if you're looking to go down a more technical path. And then we've got Think Technical regular updates anyway, and the stock research and the other resources we talked about earlier on in the presentation. If you're looking for a book, if you're a book reader there, my favourite book on methodology, hands down, is Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. It is a fantastic read and I certainly recommend you go out there and get that book. In terms of risk management, there are lots of web resources out there, but a top book is Trade Your Way to Financial Freedom by Van Tharp. In terms of psychology, getting your mind right, again, lots of web resources out there, but a few fantastic reads for you. These are my favourite ones. Market Wizards interviews, with top traders by Jack Schwager. The Way of the Turtle by Curtis Faith, and Trading in the Zone by Mark Douglas, all must reads. Of course, I'm here every second week and Ask the Experts as well, and you can catch all of my other market news updates, news, views and opinions in the market news section of the website. You can follow me or the Think Markets handles on Twitter, and we've always got these upcoming webinars where it's our job to try and make you better traders, of course. So we've got our 3 series coming up, top 3 ASX turnaround stocks, where we'll investigate some of the really beaten down stocks in the ASX and ask the question whether they can turn around. Ask the Experts, as I suggested before. That next session is on the 28th of April because I'm taking a little bit of a break in the first couple of weeks of April. And then on 5th May, we're going to have our fundamental analysis refresher. Now, that couldn't be more timely, could it, given the topics we've just discussed. The disclaimer before I leave you says that everything we've talked about today is general in nature. We are a regulated Australian broker, and that means that we do have some products that could see you lose more than you deposit. So it's important you read this disclaimer carefully, or give us a call if you have any questions at all. It's been a pleasure chatting with you today. All the best for your trading until we catch up again. Bye-bye for now.